Okay, shall we have a look then? Yes? All right, so all tax calcs, as I said, start with profit before tax. It's always the first number given. You put it straight in. Yeah, 1150. I'm going to just work in thousands, I prefer. Then the very first thing they told you about was foreign income, which they said you paid foreign tax on. So we don't pay South African tax. Do you agree? It is not taxable in South Africa. It's included in that 1150 in our P&L. So the foreign income comes off 200 deduction. You all agree with that? Okay. Then they tell you that there is a dividend received from an investment that we made of 80,000. We don't pay normal tax on dividends. We pay dividends tax on dividends. In fact, we're going to look at dividends later, but the way dividends tax works is it's a withholding tax. The tax is withheld by the person paying the dividend. They pay it to SARS on your behalf. So it's paid, done when you receive the dividend. So there's nothing else to pay. It's already paid. And so the dividend would come off here as not taxable from a normal tax point of view. So the dividend received is also a minus 80 income, not taxable. Then if you look at that information, there's a couple more things there. There are fines, which are 12,000 Rand, and there's interest on VAT, which they actually did tell you was because of some late payment, and that is also not deductible. Included in there, they also put a few things just to trick you, I think. They put in things like directors' emoluments. That is deductible. It's an expense in production of income. And there's also interest, which is is it not 12? Thank you. I'm wondering now when I look at it why I thought it was the same, why I didn't click to me that it wouldn't be the same number. Okay, so fines, the fines is 6, the interest is 12. Okay, so that one is 6 and that one is 12. Okay. So then as you carry on reading, the next thing they tell you about is the credit losses. Yes, it's the provision for doubtful debts is what we used to call it. It's now called an allowance for credit losses. And they tell you that the provision dropped, isn't it? So the credit in my financial position dropped, which means that there was a debit in the financial position that became a credit in my P&L. Do you agree? That movement of 5 was a credit in my P&L. I must reverse it. So to reverse it, I've got to take it off. Do you agree with that? It's a credit here. It's making profit bigger. Okay, I'm going to show you how you guys do it in tax, and you're going to see the same thing. Now, what happens with tax is I've reversed the accounting. I must put in the tax. What is tax for credit losses? It's 25%, isn't it? So 25% of 5 is 1.25, which would have been allowed as a deduction, but it's going the other way. So that's why it's being an add back. Do you agree it's going the other way? Now, let me just show you quickly if I have to add a line. What you normally would do in tax, remember this is the principle that I showed you this morning, which is what's in accounting, what should be for tax, reverse what's in accounting, put in what's for tax, isn't it? But now, when you look at it from tax, when you do it in tax, what you've been taught to do is to take the provision for prior year, to add that back, and then to take the provision for the current year and deduct that. Do you agree that that's what you've been taught to do? And we would only do 25% because it's only 25%. Do you agree with that? So we would take 25% of 65, which is what? 16.25, and then I would deduct 25% of 60, which is 15, and I'll end up adding 1.25. Hurrah! Isn't it? That's the tax. Yeah. From accounting, the accounting is there's your T account for your provision. We would have an opening balance beginning of year of 65, a closing balance which would be on this side of 60, which means that we had a 5 that went to P&L, and it would have gone into P&L as a credit, isn't it? So that credit would need to be reversed. So does this make sense? You can see it works out the same, isn't it? It works out the same as if we had done it the way that you've been taught to do it. All right. So credit loss for accounting, what's sitting in this number that shouldn't be there because that's not how tax does the allowance? 5. It's sitting in as a credit, I must take it out. Yeah. What should be in there is what SARS is going to allow as a deduction, but he's not allowing a deduction because my provision or my for doubtful debts reversed. So it's actually an add back, 1.25. All right. The next thing they tell you about is it a vehicle? A vehicle. And they give you the balances, I think, at beginning of year, and what you had to do was work out depreciation and wear and tear. So do you have some numbers, Christian? 60,000 wear and tear?
No, that's for depreciation.
Yeah, what do you have for depreciation? 60 for wear and tear? And how much for depreciation? The other way, hey, Christian?
Yeah.
So 60 for wear and tear, 44 for depreciation. I'm just going to put it in a bracket because there's a knitting machine. Hey, that's also going to have some allowances. So the way that worked was that the depreciation, there was a residual value, and then you had to divide by 5 years, isn't it? And then the wear and tear was a straight line over 4 years. Okay, so that's your wear and tear and your depreciation. So luckily that asset we still have, everything is cool. And then we have a knitting machine. The knitting machine we sold in September, so 9 months into the year. Yeah, did you see that? 9 months. So we have to put in 9 months of depreciation. For wear and tear, it's section 12C. 12C doesn't apportion, and it's 40, 20, 20, 20. So for wear and tear, it's 20%. For depreciation, it's 10% per annum depreciation, but only for 9 months. So do you have those numbers, Christian?
Yes, I have 3,375.
3.375 for depreciation, yes, and? Hmm? 9, yes, 9. It's just a straight 20% of 45, yeah? So then therefore, depreciation is 47,375. It's an add back. Do you agree? It's making the profit smaller, but I'm not allowed that as a tax deduction. I've got to add it back. And then wear and tear, which is what I'm allowed as a deduction, is 69. Okay, then taking that depreciation into account, we had to work out the accounting profit or loss on sale of the asset, and it works out to a loss. Do you all agree? It worked out to a loss? Wah, wah, wah. Ashley? No, I'm asking you, what is the loss? The loss on the sale of the knitting machine.
Why was the depreciation of 3.3?
3.3? Okay, let's have a look at that knitting machine. So we can also work out the loss. So the knitting machine was bought for 30. What was it bought for? 45. Okay. It's being depreciated at 10% per annum, so 10% would be 4.5. But it's only being depreciated for 9 months, 3.375. Carrying amount beginning of year was 36. So therefore, at sale date, the carrying amount is 32.625, is it? I'm doing the calculation in my head, which you know I can't do. 36, did you agree? What did we sell it for? 30. So did we make a gain or a loss? Of 2625, yes? Okay, let's do the tax calc. Because remember I said to you, we must always do the accounting calc and the tax calc. So this accounting loss must be reversed. Hey, that's not what SARS is looking at. SARS doesn't look at that. SARS looks at it from their perspective. So if we look at SARS, I'm going to put the SARS numbers just next to these. SARS, it was a straight 20%. Because it was the 40, 20, 20, 20. It's not apportioned for the year, so it's a full 20, so it was 9. Their carrying amount at beginning, I think, was 18, isn't it? Which left us with 9 at the date of sale. Yes? sold for 30. SARS is going to recoup 21. Yeah? So this is a recoupment. This is a loss. So SARS, if we look at what SARS did, we bought a machine, a knitting machine, for 45,000. Up to the end of the year, SARS has given us allowances all the way down to 9. Isn't it? They've given us 36,000 of allowances. So when we sell a machine for 30, SARS is going to say, oh, hang on, you need to pay me back some of those allowances. Not all 36, yeah, because you sold it for 30, you didn't sell it for 45. So he'll just say, okay, give me back up to 30. Yeah, he'll say, you only lost 15 on that asset. I've given you 36. So you've got to give me 21 back. Yeah, recoupment. All right, can I go back or are you making notes? I can go. So if we go back then to our calc, over here, accounting loss on sale was 2.625. And this accounting loss is added back because it's a loss. This loss was making my profit smaller, isn't it? SARS is going to say, no, I'm not going to allow that loss. You must make your profit bigger again. I must make profit bigger. Then SARS is going to say, you have to pay me back a recoupment. You have to pay me more. Make that bigger some more by 21. You have to pay me more. So in this case, they both go as adds because it's a loss and then it's a profit for tax. If it was a profit for accounting and a profit for tax, then it would be a minus for accounting and an add for tax. Because I always say to you, it's the opposite. But this one was a funny scenario where we were depreciating very slowly over 10 years. But SARS was giving us deductions over 5, isn't it? 40, 20, 20, 20. No, actually over 4 years. 40, 20, 20, 4 years. So SARS was giving us all the way into zoom over 4 years, and we were only going to depreciate nicely over 10. Okay, so that's the 21 and the 2.625. I just want to write that again so that it's more legible. I'm really struggling with this. I think I have to write like really slowly to get it to be legible on this board. All right, so then we left with two things. We left with the prepaid lease. We prepaid 9 months. Remember, we had worked it out when we were reading it. So 9 months of prepayment works out to, anybody? Nine months of prepaid. Sorry? 59,400. Yes, 59.4. And 59.4 is going to be allowed as a deduction, isn't it? So of the 70, what was the amount that we paid up front? 79.2, hey? Of the 79.2, there was 19.8 which was in the P&L, which could have checked. It works out to 3 months. The other 9 months is not in my P&L. It's sitting in my financial position, but for tax, it's allowed. Yeah? So there it is. And then there's a lease penalty. That lease penalty is sitting here as an expense. But SARS has said that they will only allow it when you pay it. Right? And that's quite common with provisions. We make provisions in our books. SARS says, yes, it's okay, I believe you that you're going to have to pay that penalty. But I'm not going to allow it to you now. When you pay it, I will allow it. Isn't it? So that's often the case with provisions. So there's an 80 here, which is an add back because it's making profit smaller. I've put in the expense. But SARS says, no, I'll only allow it when you pay it, which will be next year. 80 as an add back. So then I land up with a number at the very bottom there, and I'd like some of you to please add it up to check, especially because I made a mistake with that one number. I get 870.85. How do you feel now? Looks easy. A little better, okay. It's just, you can see how many marks it is, eh? And you just have to practice tax comp after tax comp after tax comp. But the good news is that it's more or less the same stuff that we see here. There might be the odd different thing, but yeah. Do you not get that? Minus 200, minus 80, minus 6, minus 12, minus 5. Anybody added it and it works? Yes, okay. So then we get a taxable income of, for the year of 870.850. We have an assessed loss which we bring forward from the previous year. It's going to make that number smaller by 120. So we land up with not 8. Make it nice and small. Which will make that number 750.85. Yes, and then we times that by 28%, and we get 210,238. We take off our provisional payments. Our provisional payments are 175, which we've already paid. We paid 85 and 90. So we left with tax due of 35,238. Okay, so questions. Any questions anybody has? How close were you? Good enough. A pass. Not for some of you. Okay. Okay, so there's just one more thing then that I want to do with this question, and that is to go through the items and split them into which ones are temporary and which ones are exempt, just in case you want to show your solution the way that Eunice's shows theirs, which is like this. Remember, I showed it to you, right? So Eunice's shows their solution like this. Profit before tax, exempt differences, and then in a box, all the exempt differences, then temporary differences, in a box, all the temporary differences. Yeah. So what you will see is the solution, the Eunice solutions always look like this. Okay. As I said, the benefit of doing it like this is that one day, if you have to work backwards to the temporary differences, they're already in a box and you know what the number is. Yeah. So let's just go through the differences then and identify which are which. So profit before tax is not a difference. Foreign income, exempt or temporary? Exempt. Dividends received, exempt or temporary? Exempt. Fines, interest, exempt, isn't it? Not deductible. Credit losses, temporary, yeah. Because imagine that when you actually write off the bad debt, SARS will give you the allowance, isn't it? So at some point, one of two things is going to happen with that bad debt. Either you write it off, and then SARS will give you the allowance, or you reverse your provision because you've received the money, and then you're the one that has reversed it for accounting, isn't it? And it will then wash out. Depreciation and wear and tear, temporary, isn't it? Both temporary. Why do I say temporary? At the end of the life of the assets, then the tax base and the accounting is the same. It's zero, isn't it? The asset is sold. In this case, we have one asset that we still have, and we have one that we've sold. When we sold the asset, both times we balanced back to that 30,000 that we sold it for, isn't it? And ultimately, the amount that was then in the books was the amount between the 45 and the 30, the 45 and the 30. In the one case, we had depreciated, and then we still had a loss, so we still had a bit more to account for to get to the 30. In the other case, we had been given a lot of wear and tear, and then we had to go back and recoup to get back to the 30. But in both cases, we got back to the 30. So depreciation, wear and tear is a temporary difference. The accounting loss and the tax recoupment, also part of that temporary difference to get us to zero, isn't it? The only time that you'll have a bit of exempt there is with capital gain, but there's none in this question. Then the prepaid lease is also a prepaid. It's temporary. Eventually, we're going to put this amount into our P&L next year. Yeah, at the moment it's not sitting in our P&L, but we're going to be allowed the tax deduction, but next year it will be sitting in our P&L, and then it will be the same as tax. And then our penalty, when we pay it, SARS will give us the deduction, so it's also just temporary. So if you want to show it the UNISA way, it actually worked out that the way that we've got it has all the exempts on one side and all the temporaries on the other. Sometimes it happens like that. You can just do a box around the exempts and put a heading, exempt differences, and put a total. Put a box around all your temporaries, put a heading, and put a total. Yeah? So that is the first piece of the assignment and the first practice that we have doing tax calculations. They are very important, tax calculations. It is the fundamental piece of your tax note that you do. Yeah. You know that part E asked you to do a tax note, isn't it? Maybe I can show you quickly what that tax note looks like. Let me go here. It's up here. Sorry, my hard drive isn't working, so now I can't show you. But you've got your study guides in front of you, isn't it? Have a look at page. Oh, it would be a different page. Can I have a look? Have a look at page 48. You'll see there on page 48 a tax note. Do you see it? And that whole half of that page basically that first half of the page is the income tax note and the deferred tax note. You see? So you'll see that the income tax note starts with current tax. Yeah? So the income tax note starts with a thing that says major components of tax expense, and then it says current tax expense, current year. So for part E, when we get there, and we don't have to do it now because, we're only going to write one line, so it's not really worth it. But when we get there, our first line is going to be current tax expense, current year. The other thing that could be there is when we have adjustments for prior years. In other words, when our calculation of tax differed from the assessed tax once it's been assessed by SARS, and then we have to make adjustments. But that number for now will be this number, the 210. Yeah? Not the tax due, that's what sits in our financial position. The current tax expense, which is the 210, yeah, after we have made use of the assessed loss. So that number will be 210,238, and then you'll refer back to the tax calc. Sometimes your requireds for exams say prepare tax calc 17.5 marks, like this required did. Sometimes the required will just say do the tax note for 50 marks. And then you have to do the tax calc, the deferred tax calcs. You have to do all of the necessary calcs to get the note done, isn't it, to get that answer. Okay. Let's see where we are. Yeah, I don't think I want to start with deferred tax today because I don't want to confuse you anymore. What I would like you to do, if you feel that you would benefit from it or you can do it at home, is that question that's in your study guides. So on that page, what question was that on that page that we just saw? Can I just have a look? Sorry, I don't have my material and now my hard drive is acting up. No, it's not that one that I want you to do. I wanted you to practice that capital gain. So it's example 15, page 54. Just hold that. So study guide, page 54, example 15, because the example we just didn't have capital gains, yes? I'm not going to come back and do capital gains again, because I already talked about it today. So if you could have a look at that example 15 on page 54, to do those calculations. Remember, when there's a capital gain, we're looking at accounting profit, recoupment, capital gain, exempt portion, taxable portion. Okay. So if you could have a look at that example, I'll give you a bit of time, and then if you are still here, we'll go through it in about 10 minutes.